Fixed rates are hugely popular right now.
And they're only going to get more popular as rates go up.
Today, we're going to take you through it in this fixed rate guide. So, fixed rate basics, Nathan. Explain to me what a fixed rate is.
Effectively, a fixed rate is locking in the interest rate for a set period of time. It's great because it gives you an ability to budget, especially if you've got a young family and you don't want to see the rate going up and down. A fixed rate can be a great option.
So in other words, the fixed rate home loan will keep your home loan repayments set for a period. Typically in Australia, you'll see a 1, 3 or 5 year fixed rate. There's some banks that do it longer, but the interest rates really blow out. So it tends not to be worthwhile to do it much longer. But like Nathan said, the good thing is it gives you a bit of certainty. You know what your repayment's gonna be and you can budget around that. But there are some downsides. So when might fixed rates not suit you?
Firstly, a fixed rate isn't suitable if you're planning on selling the property during the fixed rate period. So for example, if you fix in for a 5-year period and you have plans to sell it in 2 years, it can be a costly exercise.
It also sucks if you want to make extra repayments because you are limited in how much you can make in additional repayments to the home loan. So if you're expecting a big bonus, if you plan on making accelerated repayments, then fixed rates might not be right for you because you'll incur fixed rate costs.
So I fixed in my loan for 5 years and after 2 years, I need to sell my property. Jaden, I've called the bank. They're saying I have a penalty to pay. Why?
Yeah, so these are known as fixed rate costs. Some banks call them early repayment fees. There's heaps of different industry jargon. Basically what happens is when a bank gives you a fixed rate, they take a contract out with the market. So if Nathan's taken out a fixed rate for 5 years, his bank has taken out a contract with the market saying, yep, Nathan's going to be paying us for 5 years. We're going to expect this amount of interest over the 5-year period, and that's how much we want. But if Nathan breaks that contract early, like breaking your phone contract, there's early repayment or adjustment fees that need to be paid. Now these change day to day. It depends on the interest rate you're fixed at. It depends on how much is left owing on your home loan. It depends how much the money market is that day. So these costs can range from a few $100s, but typically can be tens of thousands of dollars depending on how much is left over. So that just comes back to the fact that with fixed rates, while they can be good for certainty, they can be terrible if your situation changes, because then you can be liable to pay that if in Nathan's case you've sold the property, or even if you want to make extra repayments to that loan that are more than the bank is willing to let you to do. All right, so Nathan, if I want to make extra repayments to the loan, how much extra can I make if I've fixed my home loan?
Well, it all depends on the bank you go with. Some lenders limit the amount of extra repayments you can have on the loan. So it can be up to $10,000 a year. Some look at the duration of the loan. So for the 3 years that you might be fixed in for, they might only allow up to 30 grand in extra repayments. And others will say 500 in extra repayments per month. So it is different based on every bank. So hard to give an exact answer there.
The thing is, you just need to be careful of that, because if you do go, say for the bank number one, where it's $10,000 a year, if you make $10,001 in extra payments, you can trigger the fixed rate costs, which then means you have to pay extra fees. So just be mindful of that. They do monitor that and you can get caught out. All right, so Nathan, I want to do a fixed rate. I've decided, I'm worried about the market. I think the rate's gonna go up. So what features are there that I should look out for that are good on fixed rates?
So there's a number of different features with a fixed rate that you've got to be aware of. So the first is called rate lock. So the bank advertise a fixed rate as of today's date. Now, as you know, when you get a loan, the process takes about 30 days from start to finish. So if today you've applied for a fixed rate, that can actually change by the time you settle.
It can go up or down.
So they offer something called a rate lock, where you pay a fee to guarantee that rate as of today to be the same at settlement. Now it is a bit of a sting. Some banks charge $750, some charge slightly more.
Some charge a percentage of the loan. It can be pretty expensive. So just look out for that. And like Nathan said, unfortunately fixed rates, they're changing every day. Banks are actually revising these every second day. So you just need to be aware of that and just either take the risk or you got to pay the extra for that feature.
The second feature to look out for is what's known as redraw. So some lenders do allow the ability to make extra repayments and then pull those additional repayments out. That's a cool feature to look for. Not every bank has it. Some banks charge a cost for it.
Well, I had one recently where a client had stuck a bunch of extra money in their fixed rate. They thought it was good. They were underneath their $10,000 a year cap, But they found out that the bank actually charges an early repayment fee to redraw the funds out. It was crazy. They had to break the whole fixed rate and they were going to have to pay $5,000 in extra costs. So make sure you check that up front, because if your intention is to pay it off extra, you might like our bonus strategy at the end. There's something called a split rate loan that we can look at. But that's one important feature that you need to take into consideration. The other one is a fixed rate offset account, Nathan. So how does that work? Because they're a bit different from a normal one.
Yeah, once again, every bank is different on this. So some banks will allow 100% offset account on a fixed rate, which is very rare. There's not many that do that. Others will allow an offset account. However, it's only 40% of the funds in the offset account as offsetting. So in that situation, you're most likely better off putting the money directly in the loan and then redrawing it if the bank allows it when required.
All right, so Nathan, tell me about your secret strategy with fixed rates and the best way to approach that.
Well, why not get the best of both worlds with this split loan? Effectively, what that means, Jaden, is you set the loan up in two separate positions. So one as a fixed rate, another as a variable rate. What that means is you can get the best of making as many additional repayments in the variable loan and have the security and comfort with a fixed rate and knowing what your budget is going to be for a set period of time.
Now the good thing with this is there's no right or wrong on the amount to split. Some people will do $50,000 as variable and the rest is fixed. Some people will do it 50-50. So if you've got a $300,000 loan, they'll do 150 and 150. There's no right or wrong way of doing this. In my experience, the best way is to kind of look forward the next 3 or 5 years, depending on your fixed period, work out how much extra you might make in bonuses or tax refunds, in extra payments, and sort of loosely work out that can be your variable portion. So if you know you're going to get $10,000 a year in refunds and bonuses over the next 3 years, you might want to do a $30,000 to $50,000 variable split and the rest is fixed. If you're worried you're going to sell the property, then you might do more as variable. There's no right or wrong answer here, but the fact is the best of both worlds strategy is a great way to be able to hedge yourself in case there are any changes in the future. Now, let us know what you thought of the video. If you liked it, leave a comment below. If you've got any other questions, make sure you hit us up at huntergalloway.com.au.